let's all agree that there's a magnitude of ways to set up a portfolio. You could just buy the general market, so the S&P 500. We can see how this has been doing over the past year. It's very good. This is used as a benchmark to see how you're stacking up against it. And for most people, this is the way to go. But there's a lot more strategies you could do. Some people like to set it up based off of market cap, so they go small cap, mid cap, large cap, mega cap, and that's how they view their portfolio. Another way, sector. This is VGT, information technology. Vox is another one, communication services. So that's like Google and Facebook. Sector is very popular. If we come to this heat map, so visualization of the S&P 500, we can see it's split up by sectors. So healthcare, finances, utilities, so on and so on. Sectors is a very popular way of looking at your portfolio. But there's more. So here we have VWO. This is Vanguard Emerging Markets ETF. And this is CQQQ. This is China technology companies. Now, the reason why I'm bringing this up is because when you want the best total returns, the biggest thing I learned, and I got this from Warren Buffett, is you have to protect your portfolio from yourself. So investing really isn't a solely IQ thing. The most intelligent people don't necessarily always get the best returns. The people that do get the best returns have the best temperament, the best, social intelligence. But you have to structure your portfolio to protect it from yourself. You have to have a setup that you can stick with and be confident in if you want to maximize your returns. That's the single biggest thing that you can do. So taking a look at my portfolio, I split it up a little bit differently. I split it up based off of dividends and growth. So cash flow and capital appreciation. And something I want to point out here that I did a little bit wrong is these are my ETFs. I have ARK, WCLD, Cloud Computing Fund, really like this ETF, and ESPO. And all these ETFs are indeed fantastic. There's nothing wrong with them. But right now, there's a pullback going on. They've trimmed like 20, 30% off of their all-time highs. I'm going to continue to hold them because I know I have to protect it for myself. But if I can go back and do it again, I would do it slightly differently to keep it simple and to cover my bases in any market condition and protect it from myself. So my first piece of advice is to get a cookie cutter, basic, generic ETF for whatever you're trying to do. So this is for dividends right now, and the symbol is SCHD, one of my favorite dividend ETFs. And if we read the objective, it says the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. It's basic, simple, and it kind of covers all of your bases. Another one with growth, this is the same exact thing, but focusing on growth. It's SCHG. And the fund's objective is to track as closely as possible before fees and expenses the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. The blue line is the dividend ETF, and the yellow-orange line is the growth ETF. And we can see how they perform. It's kind of exactly what you would expect. And if we want, we can put the general market in as well, and you can see it goes right in the middle. So step one in protecting your portfolio from yourself is to get a broad market ETF in whatever strategy you're trying to do. Growth, dividends, domestic, international, whatever it is, get something that's going to cover your bases and allow you to sleep at night. Trust me, when the market's going down, you're going to be happy you did this. Now, when the market's going up, you might be feeling like you're getting left behind with these ETFs, and that's why I'd recommend that in addition to these basic ETFs, get something more specialized with more concentrated risk if you want to experiment a little bit. ARK is a fantastic example of this. So you can see their objective here. They focus on disruptive innovation. It's a very specific strategy, and you can see the contrast between this and the more basic kind of index tracking of the previous ETFs. And because of this, I think they work well together. So you're covered when the market's going down, you feel protected and safe. But when the market's going up, you don't feel left behind because you have some exposure to these hyper growth concentrated ETFs as well. So if we take a look at how these ETFs work together, the blue line is that Schwab growth ETF, and then the yellow or orange is the ARK ETF. So we can see the ARK ETF has way more explosive growth. If we want to zoom out to the 5-year, we can see that it can go up a lot more in good times, but it can also come down a lot more in bad times. So that's why I like combining these, because no matter what's going on, you have kind of a base it's an index, and then you have the more speculative stuff on top of it, and if it goes down, it's not the end of the world because you have other options. So to show you what this looks like in practice, I made a sample portfolio, and once again, I do it by dividend and growth. This could be anything. This could be small cap and large cap, or whatever you want. It's still applicable. So if we come into, let's go to growth. I have my favorite speculative ETF, so the ARK Innovation. I really do believe in this and all the holdings like Roku, Tesla, Square, Zillow, all that kind of stuff. I believe in this ETF, so I don't mind holding it, but it's going to be a bumpy ride along the way. And then I got SCHG. Once again, it's that generic growth ETF that covers my bases. And then down here, I have a long tail of just more companies that I want just slightly more exposure to. So you can see this is basic, but it covers my bases. And if the market goes up or the market goes down, I'm gonna feel okay, and I'm not gonna change it up and shoot myself in the foot. If I come over to dividends, I have the exact same thing going on. So I have my basic ETF that covers my bases, and then the more speculative one. This ETF, focusing on dividends, uses covered calls and different options, and because of that, it's more risky, but it's my speculative play along with my safe one. In terms of growth ETFs, here's a list of aggressive growth ETFs, and we can see a nice long list here. I'll leave this link down below so you guys can open it up and click around. The Vanguard growth one, VUG, is also really good. It's almost identical to, if I can pull it up, the SCHG is just like the Vanguard version. So I like a lot of these. ARK, of course, is my favorite in terms of speculation. And I still do like the other ETFs, WCLD and ESPO. It's just that I like this setup for my mental sanity. And I feel like it's more durable no matter what market conditions lay ahead. But that's the end of the video. If you guys enjoyed, leave a like on your way out. And I'll see you next time.